Welcome back. Air Canada reported its most recent quarterly results about a week ago on May the 8th, and among many other things, it reported that it expects to see market conditions remaining unsteady in the near to midterm. We're joined now by a top executive of the airline, John Bert, Executive Vice President and Chief Financial Officer of Air Canada, joins us now. Thank you for coming in.
Hey, hi, Paul.
I'd love to, you know what the question is. People perceive that there's a reluctance of Canadians to travel into the United States, including booking flights into the United States. When Air Canada says we anticipate market conditions will remain unsteady with an uncertain economic outlook, is that reluctance of Canadian travelers to visit the United States part of that outlook?
Yeah, it is. And we wanted to, as we looked out to the full year, we wanted to acknowledge, that there was some pressure on transborder traffic for Canadians. But, the real, I guess, important fact for us is that we're very well diversified. And Air Canada has a tremendous franchise. About 65-70% of our travel is international travel. Mm-hmm. And so there's a differentiation as well between the leisure passenger, who has reduced a little bit of travel to the U.S. On the other hand, we've seen business travelers continue to still move around and do business. So that gets us pretty confident that we can navigate through all of this. Mm-hmm. We've been resilient and we'll expect to do so.
What has been the trend in business travel over these years, these recent years, when virtual meetings, Zoom meetings, et cetera, have become much more common?
I think that there's a definite trend towards going back to business in person, I think this focus on continuing to diversify our own economy here in Canada will help us in the mid to long term as well.
Okay. I've looked at Air Canada's financial results many times. When an ordinary retail investor looks at them, that he or she will often see the company, as in the most recent results, reporting an operating loss but positive adjusted EBITDA. Now, we know EBITDA is earnings before interest, taxes, depreciation, and amortization. Where is the difference? Are those depreciation and amortization costs on aircraft that are the big difference maker there?
Correct, absolutely. We carry about $4.7 billion of debt, net debt, I should say. And we also have tax affected earnings. But I think also importantly is that the first quarter typically is seasonally a more difficult quarter generally for Air Canada, mm-hmm. and the strength of our airline really is through Q2, Q3, and then a little bit of Q4.
Mm-hmm. Operating expenses increased by 2% in the most recent quarter. When I read that part of the results, there are clearly things here that the airline cannot control: foreign exchange, fuel prices, et cetera. What can Air Canada control? How does it try to control its costs?
Well, you would have seen in our last quarter, we actually launched a $150 million cost improvement plan. And we're making very significant investments in technology. We're enabling our frontline staff to deploy more technology. We'll be making investments in back office type of software improvements that allow us to be more productive. The introduction of a fairly significant investment of new aircraft also brings down the cost of operations significantly. These are going to be best-in-class modern aircraft. Mm-hmm. Fuel economics are fantastic. All of these things, we continue to work with our supply chain as well to make sure that we can always leverage the scale of Air Canada, mm-hmm. to bring down costs.
Tell us about the new aircraft. What are they and when are they coming?
So we have, fundamentally three big acquisitions coming. The Airbus 220, a tremendous aircraft. It's going to be fantastic for bringing passengers, across Canada, transborder. It really helps us connect what we call our Sixth Freedom franchise. There's an opportunity for us to bring Americans as well internationally through Toronto, Vancouver, or Montreal, either trans-Pacific or transatlantic. So that fleet will enable that Sixth Freedom strategy. The Airbus A321XLR. This is a narrow-body aircraft, which is a smaller size aircraft that allows us to remove some seasonality in our fleet. The 321XLR will be able to go transatlantic from our Toronto and Montreal hubs, and that's very, very cost efficient for us and can allow us to fly places like Barcelona and Toulouse in November and January. And then finally, the 787-10 Boeing product. This is really going to fuel the international airline and our ability to connect a larger, bigger network of international destinations.
Air Canada is saying that it plans to, in the second quarter, increase its available seat mile capacity by between 2 and 2.5%. That's the seats available for purchase from the flying public, right? What goes into that decision? How does Air Canada make the calculus to effectively make more seats available?
Well, we're making investments in the fleet, and we'll receive aircraft during the year. Those aircraft go into service, and you have to know that this is strategically planned, years ahead. We're very agile, so we'll bring that capacity on appropriately. We adjusted our growth for the year to 1 to 3% year over year. We think that's the right context in this environment. But we have, great growth plans through 26, 27, 28 that we still feel very strongly about.
Late last year, the company unveiled targets and aspirations for 2028 and 2030, respectively, for revenue to rise all the way to $30 billion. And there were other targets as well. What's the company telling the market when it goes so far out, 5 years out, on where it's aiming?
I think what we're telling the market is that we have an incredible franchise. And let me just give you some color around that. Number one, a very strong foundation. We have incredible brands. Aeroplan, Air Canada Vacations. So from a brand offering, we're investing in the network to continue to expand our ability to serve customers. So this strong foundation also includes a very strong balance sheet. Our balance sheet is 1.3 turns of debt, net debt, and high liquidity. So the ability to carry through that strategy is very much intact. And then finally, we're very committed to execution. The management team is an exceptional, experienced team that can execute the growth in a very efficient fashion. And what we're looking for is driving profitability, investing in the fleet while we return capital to investors.
Thanks a lot for coming in.
Thank you, Paul.
John Bert is Executive Vice President and Chief Financial Officer at Air Canada. Up next,